Meta crushed its numbers, so why is the stock tanking? Gene Munster reveals the hidden bombshell Wall Street's missing. Gene Munster names what Meta must prove next quarter to win investors back. Don't miss his prediction for whether the stock slide is just a pause or something bigger.
Dynamic between revenue growth and expense growth. And if we rewind to the past 2 years, Meta has grown revenue faster than expenses by a wide margin. 2024 revenue growth about 23%, expense growth about 8%. The first 2 quarters of this year, revenue growth 22%, expense growth 12%. They report their September quarter with 23% revenue growth, but expense growth of 32%. And throwing insult onto that is the commentary about the third-party CapEx spend for next year. And this aggressive is the word that they're spending substantial increase. Expenses related to that, we're probably going to see something like 18% revenue growth for next year for the top line. The street's at 16 right now, but probably 18%, and probably expenses growing north of 30%. And so essentially, the script that we've seen with Meta over the past 2 years got flipped. And I think it's just that simple. If you look across the board at Zuck's ambition around AI, what he's trying to accomplish, look at their engagement. I mean, just like profound engagement growth, accelerating engagement growth. 43% of the world uses their products on a daily basis. Those rate of usage is accelerating. So it was a great quarter with the exception of that dynamic, Melissa, and I think it really stung investors.
You know, Gene, this is one, again, I saw your notes earlier, you're kind of confounded, Microsoft similarly. You know, when I look at the downtick in earnings growth, though, for 2026 for Meta, I mean, isn't that the sort of thing that you would probably expect for the stock that's outperformed pretty dramatically, you know, over the last 2 years or so, to kind of take a pause?
Well, a pause is understandable, but I think that shift, that expense shift, that was something new. Like a pause to me is they've got good numbers, they beat the numbers. That one-time charge that people are talking about, that $15 million tax charge, that's a nothing. Just throw it out. Doesn't matter. But so I think, Dan, that it's I'm trying to look at like what was incremental. I could understand if the stock was down 3% on good news. That's to me taking a breather. But down 8, 9, 10%. Investors are trying to just recalibrate, I think, something bigger. And again, that dynamic around them going more to cloud. Now, I'd also point out, like around the ambitions and around AI, and I'm all in on this being more transformative than where I think high expectations are. But Zuck basically is setting himself up to be the most optimistic of any of the big tech CEOs, as evidenced by their increase in CapEx. So it's going to be up. The street's looking for 40% growth right now for 26. They didn't give detailed guidance around that, but it's probably going to be up more than 60%. And if you look at what Google just guided up, their CapEx, and imply that for next year, they're going to be up like 25%, and Microsoft and Amazon around that. And this one comment kind of stuck out to me. He said, we're building our AI infrastructure for the most optimistic, that was his word, the most optimistic case for AI. And I think that's the right thing to do. But that is a little bit unsettling when he talks about the most optimistic case we're building for. And so I think, Dan, I think that's kind of playing into it. I think it's more than just had a good run and kind of taking a breather. I do think that ultimately he's on the right track. Like I fully support everything that's going on. I think that the stock is going to reverse these losses in the weeks to come.
Gene, it's Karen. Thanks for being on. How quickly does the street need to see a return, and how big does that return need to be to justify the spend like this?
Well, we go through the recalibration, and that's what's going on now, and it'll happen tomorrow. And then they need to see it in the December quarter in the form of whatever that revenue growth rate is to be higher, a little bit higher than what people are thinking, and then the expenses to be hopefully a little bit lower than what people were thinking. And so, I mean, there's, this is a long-term thing, a long-term opportunity that they're investing into, but they are being marked every quarter. And so I think that they do need to show some improvement. And I think I mentioned earlier this 18% growth for next year for the top line. The street's at 16 for Meta. I mean, it probably needs to be something like 20%, and them showing that in fact this is driving revenue, just like their AI. It's been the best example of any company at scale using AI to accelerate revenue growth, and they need to continue to show that in the December quarter.